When the market just had its reaction like it just had, most people don't want more bonds. They want more stocks, and they want more high flying stocks. I think a lot of people probably have thought through this as well, and I'm going to share, I'll let them go nameless, but they're in my family and they're wonderful. And there's always a little tricky when you manage money professionally with Mike and our team, and there's family. And I think this is what's really tricky, and I hope maybe this will click. So, what's happening is they've had a traditional fund manager at a big retailer, low-cost provider for decades. And the last thing in the world I want is to disrupt that because they're family. We love them. And what's the really hard part is as people age, and you tell your traditional advisor the traditional modern portfolio theory, which is you have this much in stocks, this much in bonds, this much in cash, there's an algorithm. And you say, this is when I'm going to retire. This is how long I expect to be in retirement. I'm a 0 to 10 on a scale of risk. And most people say 6 or 7 is how it usually works. And when the market's really good, you go to like 8. And when the market's pretty lousy, you drop to 6 or 5. And what happens is, as you get older, they will sell you down, meaning if you're in a, let's say, 70% stock mix, the algorithm, which the person operating the algorithm has very little say, they're just an employee, it'll drop you to a 60-40 mix, which means now you own about 10% more bonds. And when the market just had its reaction like it just had, most people don't want more bonds. They want more stocks and they want more high flying stocks because that's just the way humans and all of us are built. So the hardest part is they asked me, they said, well, what do you think? And this is where it gets really tricky for me because my opinion today is based, I don't believe anymore in a static allocation. I believe in an allocation that ever moves based on the market. And I'm from New England. I had 20 great years watching Tom Brady, and Tom Brady was great for many reasons. He's probably unlikable to most because he won so much. But what was really great about Tom is that he didn't mess up a lot and he didn't turn the ball over a lot. And what Tom did was he would read the defense and he would play the high probability trade. That's the play he'd run. If there was a coverage he liked, or if he couldn't figure it out, he'd just throw the ball out of bounds. He just would try really hard not to turn it over. And when the market is a 10 out of 10 on our stock score, we're 100% invested. And when the stock market score is a 5 or a 6 or a 1 or a 2, you're going to play a different play. So what's really hard for me, which I had to deal with, is what do you think about the market? And the answer is, yeah, I totally agree. At the moment today, I would say I don't want 10% more bonds. I want more stocks. And I totally get it. And the reality is, if you look at a chart of bonds, it actually looks decent because Warsh is coming in. They're going to lower rates, and bonds will likely do just fine. But stocks have done way better, and because they have more volatility. So if I put that into a case, let's take we are part two of this, which is my biggest concern, is we're at a pretty expensive market. Meaning, if you look at it from a price to sales, earnings to or a price to book, if whatever valuation metric you look at, this market is pretty expensive. So especially tech. So are we as expensive as we were maybe in the dot-com boom? We're getting close. So let's say next year, let's say earnings trajectory slows, or you have inflation with not much earnings, or something happens next year or the next few months, and the earnings right now are from before the conflict in Iran, and everything's rosy. I mean, there's a couple of companies that fell, but they're still really producing. So when I say to someone like, yeah, I'm 100% in stocks, or I'm 100% risk, in some models it's like 80% risk, but it's really interesting where if you take that into account with like the trend roadmap strategy that we share in this newsletter, like a year from now, I might not be. And having someone to share that static allocation, I think we can all empathize with that. So my thought to you all, and I'll open it, Mike, as I bring up the slides, is just Like, what is your belief system? Is your belief system that when the trend is working, short-term, long-term uptrend, I think you got to get in. I think you got to just play the cards that are play what the defense is showing you, throw the ball. And I think when the market's showing you what it was showing you back at the kind of the end of February or during tariffs or in 2022, maybe you just run it or maybe you just throw it out of bounds and you just survive to win. But Mike, I'll stop there. This is a challenging moment for everyone that is a part of their portfolio that's a buy and hold. This is like you want more equity, you want more risk because the market's at all-time highs and I mean, we're producing really sound returns here. We're going to cover the May billion-dollar fund manager rank. There was a few names that fell off. There were some names that were added. We're going to cover the themes that we have found, which I think are important because this market is moving quickly. So the May billion-dollar fund manager rank update. Number two, we'll talk earnings season. There's been some really great experiences like Seagate, and there's always going to be one or two that are not. So we'll talk about that as well. We'll talk about the ticker tool, which we'll look at that and then some. So today's May 1st. We're going to cover the billion dollar fund manager report. Before I dive in, world's quickest disclosure. This is just information. It is not a direct solicitation to go buy or sell anything. We want you to manage your risk, manage your belief systems, your philosophy, but make sure that your good gains hold. Again, we thank you. If you have questions, we'll cover them here or at hello@investwithroyals.com. If we ever reference another side of our world, we also run a fiduciary advisory practice where we do this strategy and two others, where we buy people's time back and then we click the buttons when it's really hard so you can live peace of mind lifestyle. So, Mike, why don't you start us off? We're going to talk the May billion dollar fund manager rank. But, Mike, why don't you kick us off and we'll go through the three themes that we saw as we cut through the data as we approach this new month.
Yep. So before we do that, I just want to go back to your story. We had two pertinent comments that I wanted to throw in. Kelly mentions, by the way, with your Brady story, you got to get with it. We're talking about Patrick Mahomes now because we want to keep current. So come on,
Okay,
Bisky
so,
Scott.
so we'll talk Drake May then. Is that fair? Or do you want to talk about Bo Nix in Denver? No, aren't we all mentally done with Pat Mahomes?
Oh, yeah. I think a lot of people would beg to differ with you.
No, they're going to be good this year. It's going to be painful again.
Yeah. And then Jim says, ask me on my risk tolerance Monday, and I give you one answer. And again on Thursday, I give you a different answer. Absolutely, Jim. We're all human. And that's why I kind of made that comment about trying to shed the FOMO. Pick your path, pick your horse, and give it a chance to participate in the race.
You know what's funny, Jim, is I used to joke with clients when I worked at Fidelity for almost 2 decades. I'd say I'm a 10 when it's going up and I'm a 0 when it's falling fast. So yeah, I totally get it.
Yeah. And then William comments, it isn't good to have investment style drift. Absolutely. And I will fully admit I've been guilty of that over the years. And it's a great, I've mentioned this in the past, it's a great peace of mind. Once you actually settle, you understand yourself and you settle on the style that works best for you and the strategies that work best for you, it's a liberating feeling. So I'm hoping that all of you are at that point or heading to that point because it's a good thing. And William's spot on that drift is not necessarily a good thing. All right. So, Scott, to your point, let's talk billion dollar fund manager. We did get the May report published yesterday, which is exciting. It's always, call me a major nerd, but I always get excited at the end of the month knowing that we're going to get the data at some point. We never know quite when we're going to be able to get the data. And getting it is kind of like a kid in the candy store, just jumping into it and seeing what's happening. And we have a few different themes that have come out, and we're going to show the full list, but a few different themes that have come out of the data as we've been dicing and cleaning it and creating the report. So the first one is AI is not ending. It seems like almost every other day, or at least once a week, you hear a story about the AI spectrum of trades or companies just falling in on themselves and collapsing. But it's interesting. It's our data showing it's not ending, it's broadening. And so you've got buying in things like, believe it or not, Intel and Micron, VRT, Celestica, etc., and selling in Applied Materials, Lam Research, MongoDB. So a bit of an internal rotation within AI. So AI is not going away, but a bit of a rotation within AI, especially to the memory companies. And any comments you'd make on this or anything to add here, Scott?
It's interesting because there's a lot of software that got absolutely destroyed the last 6 months. But here's an example of, so this was on our list in the past. It's not on our list now. At least I don't believe it is. Last night or this morning, Twilio, TWLO reported, and they are the connectivity between the computer and your phone. It texts you, or AI in your phone. So as more people are creating these agents, they're going to want to text people's phones because people have their phone within an arm's length distance from them. So, as an example, there are going to be some winners in the software space, but there's definitely the infrastructure, the energy is the winner, and it's really fascinating. And these large funds took the chance in the month of March when the market was down to buy their favorite AI tickers.
Yep.
So we're going to go to number two, since we want to leave a lot of time for questions and all that fun stuff. Number two, a shift to cash flow and resilience. So we saw some kind of resurgence in buying in GE and NRG, so power, discount retailers that are hard to throw off their kilter. We own ROST stores. Here's TJX. We had some earnings of the payment providers, Visa, MasterCard, and your coffee buzz. Starbucks is at the top of the list. Dutch Bros at the top is coming up. We unfortunately we had a sale in Delta. There it is. Carnival Cruise Lines, Hilton, GM, UPS. So shedding some of those tickers that showed up, some selling. So we noticed that. Prioritizing cash flow and pricing power. And if energy does keep climbing, this chews into some margins. If you're running a cruise liner or you're delivering packages or you're selling cars, it all slowly hits. Anything you'd add before moving to slide three?
No, I think let's hit the third one. And I think the third one, Scott, really is summed up by non-correlation. By that barbell of buying growth, continuing to add to growth, and selling off things that aren't working, but also having that non-correlation so that when you're buying growth, you're also buying, just to your point from earlier, things that are a bit more durable and that can withstand some of the volatility. Anything you add?
Yeah, and it's interesting. So the barbell, so growth, which we talked about already, but it's where do you hide to balance it? And it's interesting. We saw large cap biotech. So that was interesting. So Biogen, Alnylam, Terra, Gilead. So it was interesting to see some because healthcare is was has underperformed, but these are some areas where they were adding ballast to their growthier things in their portfolio. And it's interesting to see that some of the gold mining companies we saw, I think it was Newmont, their free cash flow numbers were impressive because gold's gone up and they dig gold out of the ground and they're selling it at a way higher price. You'd think that's would make the price boom even further. But what's interesting is they are letting some of that go, which is really fascinating that they've already, maybe that run, that expectation is already maybe at this moment baked in. And then maybe if it pulls in, then they reload the boat. But at this moment, they were letting it go. And again, Mike, anything you'd add on the three themes before we pivot to just the top of the rank?
Yeah, no, I know. I think you covered it. We covered it decently here. So I think we'll see it when we turn to the full list, which I think is what we're going to do next, right?
Yeah, so what we do, so even though there's some really great merchandise, and for some reason when I'm sharing on Zoom, it doesn't move to the next slide, which is frustrating. So I'm just showing you the whole gamut, if that's okay. So we run everything through our trend roadmap. So what the funds we're buying is part the left of the Venn diagram, the right is the trend. And even though they're buying, because they are traditionally GARP, growth at a reasonable price type investors, we're trying to figure out very quickly of that list of 100 ranking items, what's a gas or overheat? Like where are they, like where is the trend beautiful? And that's what we're going after. And we're cautious on a stage three topping pattern. We avoid all these break signals and we'll pay attention to U-turns, but it's really, we're going after this green segment. So I'm going to share the top of the list this morning. So Mike, what were your initial comments or thoughts when you look at the top of this list?
First, besides the fact that it's demonstrating some of the points that we're talking about the past couple of minutes, I do want to point out another thing is you may notice that the April list was 97 tickers. We're now up to 120. So an additional 23 tickers. And there wasn't a whole heck of a lot of rotation. There weren't a lot of things that were booted off the list. It was just more ads. And I think that's telling. In fact, Scott, I'd like to get your comments on why you think that there might be additional tickers. And I have a feeling that part of it is that bottom was in, or of course, they didn't know it at the time, but they're adding to positions as they're getting more value plays. And it leads to us seeing these additional ads. But Scott, what say you about that?
So we've come a long way in this secular bull market, and there's new names and there's new merchandise. And as time goes on, they will figure out who are the sustainable businesses that will thrive in this new world of AI and who will not. And I don't necessarily trust every pick, but I trust the fact that they're deploying lots of capital at this and
Mhm.
they're putting their money where their mouth is or where their brains are or where their collectives are. And this is, they're modeling all of this. So it's interesting to see like a couple of good examples, like who would have thought Starbucks is back at the top? It's the same Nichols who turned around Chipotle and grew it beyond belief. He's possibly going to do it again with Starbucks. They've had a slow go. You're seeing tickers in the semi space. You're seeing, and then you're also seeing this. My final item here is you're seeing a big disparity between who's doing well in the Magnificent Seven and who isn't. And
Mhm.
you saw Meta had really strong revenue numbers, but down 10%. I think if anyone that we work with owns it, we've minimized it beyond belief. And you've seen Microsoft struggle, and then you've seen Nvidia come back. Yesterday was not the greatest day, but you've seen Nvidia come back. You've seen things like we own, Google and Amazon thriving. And I think that's what's really interesting as they are spreading their bets, finding new companies that will win.
Hopefully, just overall, we hope that us putting this out each month, getting it out just as soon as possible, as soon as we get the data. Yesterday was actually record time. We got the data in the morning, we got it out in the afternoon, which is record time for us. We hope that it really helps you and it keeps your pond of ideas very fresh and makes you successful.
Yeah, so let's look at the watch list just for a moment. So here's the top. Above it is obviously the model portfolio. If there's any family, friends, or acquaintances that like the stock market, the model portfolio is having a strong year. We'll cover that in a moment. But we added the value ETF flat on the day, but you'll see Keysight is a new merchandise at the top. Arista's been there, South Korean, which is the ETF, which has a lot of semiconductors. Asteria Labs, just be careful. There's some earnings coming really soon next week.
Yeah.
So that's why they're in blue. But you'll see things that just reported that's had a really good run for us. Monolithic Power, but this is normal. That's tolerable after a great run. Vertiv, Siena's new on the list. Celestica's back on the list. Lumentum, again, a lot of these are reporting in the next 2 weeks, so be careful in blue. But we want to show it to you if you're someone who that's part of your process is to just go for it or position size really small, which will lead us
Yep.
to managing through earnings. Mike, why don't you kick us off and I'll chime in?
Yep. And it's interesting, the deck, all of our pretty graphics went away. We had some pretty graphics here, so forgive us for the simplicity of this slide. But that's the fun of technology, bringing things back and forth. But anyway, let's hit the five key things that we just wanted to put out as a reminder. We've talked about how we manage through earnings a bunch of times. In fact, I think it's in our FAQ on the portal. You could always go back to it there. But it really comes down to five things. The first thing is having a plan. And we talk about this almost ad nauseum, whether it's about earnings or anything, risk management, your overall process, have a plan. Because if you don't have a plan, you're winging it. And if you're winging it, you're probably going to be prone to getting some cuts and bruises here and there and really hurting yourself. So whatever that plan is, have a plan of how you're going to handle earnings. It could be literally something as simple as I don't care about earnings, I'm plowing forward. Or it could be really kind of relatively detailed, like we have it, where we do pay attention to earnings, whether it's something we're adding or something we're holding. The next is defining your risk. is making sure that whatever your risk unit is, say it's just a simple 10%, that you are minding that. So, in other words, if you're holding company XYZ and it's got earnings come up in a couple of days, and you're down 5% in the position and your risk unit is 10%, so you're halfway towards your risk unit, you may want to really think hard about, do you hold that into earnings where it could gap down and you blow through your risk unit? Or on the flip side, you could have a gap up. You just never know with earnings. It's almost a crapshoot. So the point is define your risk and decide. Like in our case, we want some kind of buffer before we go into earnings. So I think there was a recent, I forget the ticker, Scott, but I think it was last week, we were going into earnings and we sold off a ticker that we did not have a cushion on because we didn't want to take the risk of blowing through our risk unit.
We got out of Lamb and we moved into Taiwan Semi.
There you go. Thank you. Your memory is always better than mine. The third is know your dates. We do our best to show the dates as best we could find them. And Scott was showing them blue when it's within 2 weeks. We highlighted them blue. And however, we're going on a couple of sources that we know of that are pretty good, but there are a lot of different discrepancies that come up with earnings. So please, whatever you own, check your earnings. Don't take what we say as gospel. Don't take what another source says as gospel. Take a look and verify when earnings are coming up. That's just our advice.
Yeah, and sometimes, again, most softwares have this. TradingView has an E at the bottom, which I'm clicking on, and it will tell you. But sometimes they're inaccurate because the investor relations team changes the date and it doesn't always feed perfectly. But I
Yep.
just want to show you where that is. And if you're using other software, they likely have it as well.
Yep. And also, if you want to get really nitty gritty, be particular on when it is during that day. Say earnings are next Tuesday. Is it Tuesday before the bell rings, the opening bell rings, or is it Tuesday after the closing bell? That's important. And I'll fully admit that over the years I've been caught a couple of times where I thought, oh, I could manage ticker ABC sometime tomorrow because earnings aren't until after the closing bell. Lo and behold, I found out they were in the morning. I got burned. So just know your dates, know the timing, etc. The fourth thing is sizing the position appropriately. We talk about this a lot. Our standard position sizing is 5%. So ideally having 25% size positions in our model portfolio so that they're big enough to matter. They're not so big as to really hurt our portfolio badly on a gap down or something really bad happening. So that's the other thing where perhaps your process is your plan says, hey, if I don't have a cushion of X, I'm going to cut my position in half going into earnings or whatever it is. But just always look at your position size and make sure that a gap down, a gap up, it would be great, but make sure a gap down doesn't overly hurt your portfolio. And then lastly, stay disciplined. We say this a lot, consistency, discipline, just stick with it and don't try to hop different strategies with dealing with earnings because likely it's gonna hurt you. Emotions are gonna kind of come into play, etc. Scott, anything to add or
I think you
yeah,
crushed it. I
thank you.
would say that if you're losing sleep, if you're feeling nauseous, if you're looking too much at the
Yep.
ticker, if you're celebrating like you won the Super Bowl, you're likely sized too big. Mike, we'll pivot to the weekly market wrap. Why don't you start and I'll chime in as well.
So first off, market wrap. We've actually updated this a wee bit. We took a noisy slide and made it noisier because we thought we had some good information to share with you, but we now broke it up into two. This is the performance recap. So like we typically do, starting at the far left in the middle of the page, we look at this week's performance and then year to date, trailing 12 months in the third row, and the SPY, S&P 500, and the Qs having a really decent week and have really come back nicely year to date. International is working its way back. Oil has now had a second, as memory serves, a second really nice week. And you can see year to date, it's really, and I say oil, PDBC is a basket of commodities. Oil is the kind of the bigger chunk. So I say generally oil, but PDBC, let's call it commodities, really nice for the week. Gold, a little bit of a hit in the chin this week, but still doing nicely year to date. And trailing 12 is just amazing. Bonds, down a little bit. US dollar down a wee bit. IBIT having another decent week, kind of clawing its way back, but still down over 10% year to date. And trailing 12 is pretty nasty. We're having a pretty good, decent week at 10%, year to date 12.9, and a really nice trailing 12.
The
Oh, yeah.
trailing 12 is a little deceiving. Just
Yeah.
it's after tariffs. So the
Yeah.
low happened in April of last year. So you've wiped out all of the tariff items. So you're just looking at a relatively only a strong market. So it doesn't take into account last year's risk. So just note that that's part of the equation. But I'll turn it back to you if you want to cover anything else.
Yeah, so the what we did add is we added this section, the next few rows, kind of towards the bottom of the sheet, is just we look back to 2022 because that's for our model portfolio. We've got very detailed records going back through 2022. So since 22, we looked at for these same asset classes, what's been the overall return since the beginning of 2022? So for example, for the SPY, it's been 52.2%, pretty nice. What's been the largest drawdown during that same time frame? For SPY, no big surprise, it was minus almost 25 or over 24% back in that nasty year of 22, where, as you recall, everything was getting hit. And then we did what we call a reward risk ratio. There are a lot of ways to calculate this. We decided to keep it simple to say, okay, your reward is in the case of SPY, 52.2%. You risked your drawdown was 24.5. Your ratio dividing the two is about 2.1. So in other words, 2.1 to 1. And we did it for all the asset classes coming across. And it shouldn't be surprising to anybody. The Qs had a bigger drawdown than SPY, but definitely higher top end performance. You go over the gold. Gold, really nice. So an incredible upside since 22. Not too shabby a drawdown at 17 and change percent, giving you an amazing 8.7 ratio that we just talked about. Bonds, you got to take with a grain of salt because is it with dividends, without dividends? So we'll kind of pass on that a little bit. You go to Bitcoin. Bitcoin has had an amazing run, but at what cost? So how many of us could have stomached an 84% drawdown in anything? I know I can't. There's no way I could. So while Bitcoin has done amazing, and by the way, represented by GBTC, that ETF's been around longer than IBIT, which we normally use, but it's been had a great return, but at what cost? And then to wrap up, before I flip it back to you, Scott, with our model portfolio, nice upside, 69% change up, and a max drawdown of 12.6%. And that was back in 22 for a ratio of 5.5. So pretty darn good. So in other words, we're getting a decent upside and for the amount of risk that we're putting out there. Scott, anything you'd clarify or add?
Yeah, if you lose 84%, you need a 525% return to break even. How fun
Hmm.
is that? Yeah, I would just say really quickly,
Go for it.
we're 10 out of 10 on risk. Our beta's 1.2, so I hope you can see the screen.
Yep, we can. Yep.
Okay, amazing. I just lost visual. Portfolio heat we're watching closely. We went from a sea of yellow and red to a sea of green and blue, which is really productive. But I would say this is despite how you feel, despite I kind of like it when people throw Case Shiller warnings and different things at me because it probably means the market kind of consolidates and goes higher. We'll look at the SPY really quick, or the IVV or S&P or VOO, whatever ticker you like. We are on an RSI over 68. There's an orange box which says overheat, but you're still on a gas signal. The coolest thing, so this is the trend roadmap ticker tool version 1.1.2 because it has these red arrows and it has a little bit clearer definition of, let me give you an example of a red X. Let's do Soxel. Remember this red X? And after the red X is an RSI over 88, it tends to pull back. And now, lo and behold, you get the green arrow again and you don't have the red X. So you're on a gas signal and the market consolidated a little bit and it's going higher. But let's look at STX. Mike, what say you about Seagate Technologies and the run that it's had?
Obviously, an incredible run. It's been riding along with some of the other real stars, DC, SanDisk, etc. And we actually actually, let's walk through, Scott, how we've played this so that people can see the buy and the two trims so far. Does that make sense?
Yeah, so Seagate we was added on 4.8 based on capital. So it got the gas. So you
Yep.
had these red arrows. You got the gas on April 1st with a confirmation signal. I don't know if we at that time weren't adding or we were fully exposed based on the stock market score, but the Seagate was early and out of the gate before the market. So you got confirmation signals, and we added on the 8th, and then it went overheat. And then it still has these confirmation signals. So it's even though it's overheated, it could keep climbing. The confirmation signals left, and we had to do some trimming based on size. And then it had earnings, which is that E at the bottom. And you can see, I don't know if, I think that moon indicates after the close. I assume there's probably a sun if it's before the open, is my guess.
I would guess, yeah.
And then it gaps up and you have more confirmation signals. So pretty cool to see visually. You have the case study. You had the confirmation arrow here, and whether you wanted to trim here or just if you, let's say, hypothetically exited somewhere here, you still had a profit. But this was a really clear signal. Anything you'd share on Seagate?
Yeah, and just to be specific, our first trim was, and that was on stop loss extension. Our first trim was on the 17th, right there. And then our second trim was this week on the 29th, which was a few days ago.
Yeah, it
Yep.
was in when it was close to the highs of the day here.
Yep. And you could sit here and say, too bad we trimmed because our gains would be that much better. But we look at it differently. We're managing risk. And sometimes it's, once again, it's that short term, anything could happen short term in the market. It's almost like a crapshoot. It could have pulled back and we could have looked like heroes. So we're super happy with our process and the fact that we trimmed twice and we still have a full position that's doing what it's doing.
Okay, love it. Again, thank you for being a part of this and enjoy your day, your weekend. Take care. I hope this helped you identify some uptrends or things coming to uptrends, but please always do your due diligence, manage your risk tolerance. This is not a direct solicitation, just things for your watch list. I hope it was helpful, and I'll see you at investwithrules.com.